Picture this. Your first paycheck has finally arrived. Whether it is from a summer job, a side hustle, or your first full-time career position, you have likely heard the advice to make your money work for you. However, when you open an investment app, you are immediately confronted with two heavy terms: stocks and bonds. Which should you choose? What exactly makes them different? And why do people hold such polarized views on them? Today, we're breaking down these concepts in the simplest way possible. No jargon, no tedious finance lectures, just straightforward answers to help you navigate your financial journey. Please note that this video is for educational purposes only. Let's get started. Section 1. What is a stock? The simplest way to understand a stock is to view it as a tiny slice of ownership in a company. When you purchase a share, you become a part owner. Take my friend Jake, for example. He's 22, works at a local coffee shop, and is a fan of Apple products. One day, he decided he wanted to own a piece of the company, so he invested $500 to purchase 2 shares. 6 months later, Apple launched a successful new product, sales surged, and Jake's initial $500 investment grew to $650. He didn't have to do any extra work. He simply owned a stake in a successful company. This illustrates the two ways you can make money with stocks: capital gains, which occur when the stock price rises and you sell for a profit, and dividends, where companies pay out a portion of their profits to shareholders as a bonus. Note, however, that not all companies pay dividends. Rapidly growing firms like Tesla often reinvest their cash to expand further. The trade-off for this growth potential is risk. Stock prices can be highly volatile. If Apple had performed poorly, Jake could have easily lost money. High rewards come with the potential for high risks. Section 2. What is a bond? Bonds operate differently. When you buy a bond, you are not buying ownership, you are acting as a lender. You're effectively loaning money to a corporation or the government, becoming the bank yourself. For instance, if the government needs funds to build highways, they might issue a $1,000 bond with a 5% interest rate over 10 years. Every year, they pay you $50, known as a coupon payment, and at the end of the decade, they return your original $1,000. It seems straightforward, but bonds have a specific quirk. Suppose interest rates in the broader economy rise to 6% a year later. Now, new bonds pay $60 annually. Suddenly, your 5% bond looks less attractive compared to newer options. If you wanted to sell your bond, you would have to lower its price, perhaps down to $900, to make it appealing to a new buyer. This is the golden rule of bonds. When market interest rates rise, bond prices fall, and vice versa. They move like a seesaw. Section 3. The key differences. There are 5 main points to consider. First, ownership versus lending. Stockholders are business partners, while bondholders are lenders. Second, how you earn. Stocks generate profit through price growth and dividends, while bonds rely on steady interest payments. Third, risk level. Stocks are like a roller coaster, thrilling but volatile, whereas bonds are more like a merry-go-round, offering more stability. Fourth, return potential. Historically, stocks have returned about 8 to 10% annually over the long term, compared to the 3 to 5% typical of bonds. Finally, your role. As a stockholder, you may have voting rights on company decisions, but as a bondholder, you have no say in how the organization is run. Section 4. Real-world strategy. The million-dollar question is, which should you choose? The answer is both. This is the core of diversification, the philosophy of not putting all your eggs in one basket. Consider Marcus, a 25-year-old at the start of his career. He might hold a portfolio of 80% stocks and 20% bonds because he has 40 years to recover from market swings. In contrast, Linda is 55 and nearing retirement. She likely holds 30% stocks and 70% bonds to prioritize stability and protect her savings. This balance, known as asset allocation, should shift as you age. Bonds often act as a safety net during market downturns, providing the cushion that investors rely on when stocks decline. Section 5. Practical tips for beginners. Before we finish, keep these 3 tips in mind. First, start with what you know. Invest in companies whose products you use and understand. Second, think long-term. Avoid checking your portfolio daily to prevent panic selling during temporary swings. Set your strategy and review it quarterly. Third, start small, but start now. You do not need a fortune. Many apps allow you to begin with just $5 or $10. The true power lies in the compound growth of your investments over decades. Stocks provide growth, bonds provide stability, and the smartest investors use a mix of both. If you want to dive deeper into how stocks work, click the video popping up on your screen. Don't forget to like and subscribe for more, and I will see you in the next one.